Welcome to a special investigation into a pervasive, yet often unacknowledged force reshaping the modern economy and our daily existence. For decades, we've observed market dynamics influence the cost of goods and services. But what happens when the very fabric of our lives, from our homes to our health, our education to our infrastructure, transforms into an asset class primarily driven by financial returns? Tonight, we delve into the everything premium, exploring how the relentless financialization of core societal functions is creating profound shifts, altering access, affordability, and the very definition of value.
It feels like everything essential now comes with an invisible, insurmountable premium. Take housing. It's no longer just shelter, but a speculative investment vehicle. We see institutional landlords buying up thousands of single-family homes, hiking rents, and making homeownership an increasingly distant dream for many. In cities like Phoenix or Atlanta, families are competing not just with other families, but with multi-billion-dollar investment funds, pushing housing further out of reach. This isn't just about supply and demand anymore. It's about financial engineering dictating where and how people can live.
Chloe highlights a critical observation. The tangible assets vital for everyday life are increasingly priced through the lens of capital markets. This financialization manifests in observable metrics, diverging from traditional economic relationships. We track the ratio of median home prices to median incomes, for example, and the acceleration in this divergence is starkly evident across developed economies. Where housing affordability once tracked relatively closely to local wage growth, it now frequently outpaces it by multiples, often driven by global capital flows. Furthermore, the increasing securitization of everything from rents to healthcare receivables demonstrates this systemic shift, creating new layers of financial claims on real-world economic activity.
From an institutional perspective, the search for yield has become an imperative, especially following prolonged periods of low interest rates. Pension funds, endowments, and sovereign wealth funds have immense capital to deploy, seeking stable, inflation-hedged returns. Real assets like housing, infrastructure, or even certain healthcare facilities offer precisely that, often generating predictable cash flows insulated from short-term market volatility. We've seen significant capital allocations pivot towards these alternative investments, transforming them from niche opportunities into mainstream portfolio staples. The strategic acquisition of vital community assets by large funds is a rational response to their fiduciary duties, albeit with broader societal implications.
The current state reveals a clear pattern. Essential services are becoming financialized assets. But what are the deeper, structural forces that have propelled this profound economic transformation? How did we arrive at a point where the fundamental needs of society are increasingly subject to the logic of Wall Street?
A primary driver has been the global monetary policy landscape post-2008, characterized by persistently low interest rates and quantitative easing. This environment reduced the returns on traditional fixed-income investments, compelling institutional investors to venture into less liquid, higher-yielding asset classes. The reach for yield became a self-reinforcing cycle, driving capital into areas like real estate, infrastructure, and even intellectual property, inflating their values. Central bank actions, while aimed at stimulating aggregate demand, inadvertently channeled vast sums into asset markets, seeking any premium available. This created a powerful incentive for corporations to engage in financial engineering rather than solely focusing on operational improvements.
Precisely. We can observe a direct correlation between falling discount rates and rising asset valuations across diverse sectors. When the cost of capital is near zero, the present value of future cash flows from any stable asset becomes significantly higher, irrespective of its underlying productivity gains. Moreover, corporate governance increasingly prioritizes shareholder returns, often leading to strategies like aggressive share buybacks, which boost EPS but don't necessarily invest in long-term productive capacity. Our models indicate that the cumulative effect of these financial incentives has been a misallocation of capital away from organic growth and towards asset acquisition and financial restructuring. This is further exacerbated by the rise of complex financial instruments that allow for the repackaging and trading of these cash flows, creating vast secondary markets for previously illiquid assets.
From the consumer's vantage point, we've also seen a significant shift in who bears the risk. Deregulation in sectors like banking and healthcare, combined with the decline of defined benefit pensions, has pushed more financial responsibility onto individuals. We're now expected to manage our own retirement investments, navigate complex insurance policies, and bear increasing out-of-pocket costs for healthcare and education. This means we're more exposed to market fluctuations and less buffered by institutional safety nets, effectively becoming small-scale financial actors, whether we want to be or not. The system has shifted from protecting citizens to empowering capital, and the consequences are felt directly in our wallets and our sense of security.
The underlying forces are clear: loose monetary policy, the relentless pursuit of yield, and a shift of risk to the individual. If this leads us to the growing chasm between institutional logic and consumer reality, a divergence that defines much of modern economic life. How does this financialization manifest in the lived experiences of different groups?
The divergence is glaring and profoundly unfair. While institutional investors celebrate record returns on their real estate portfolios, families are struggling to afford rent, let alone save for a down payment. In many urban centers, a significant portion of a household's income is consumed by housing, forcing impossible choices between basic needs and a secure future. The idea of a fixed-rate mortgage becoming a primary means of wealth accumulation for the middle class is rapidly eroding, replaced by precarious rental agreements managed by faceless corporate entities. This creates a perpetual state of financial precarity for many, undermining aspirations for stability and upward mobility.
For institutional actors, the focus remains on optimizing returns within a volatile global landscape. If a pension fund can acquire a portfolio of single-family rentals that provides a stable 6% annual yield, it is considered a prudent allocation, fulfilling its mandate to beneficiaries. These investment decisions are driven by quantitative models and long-term financial projections, not by individual housing preferences or social policy objectives. Furthermore, companies in sectors like healthcare are increasingly structured to generate returns for shareholders through complex billing practices, aggressive debt financing, and M&A activities. The market rewards efficiency and scale, even if that efficiency is achieved by prioritizing financial metrics over direct service provision.
The data vividly illustrates this growing divergence in wealth accumulation. We observe a sustained increase in the wealth-to-income ratio, meaning that wealth, primarily held in financial assets, is growing faster than the underlying productive economy. This disproportionately benefits those who already own significant assets, exacerbating wealth inequality. The Gini coefficient, a measure of income inequality, shows a consistent upward trend in many developed nations, mirroring the increasing financialization of their economies. Furthermore, household debt levels, particularly consumer and mortgage debt, have escalated as individuals try to maintain living standards in the face of rising asset-driven costs.
The picture becomes stark: a system optimized for capital returns, often at the expense of equitable access to essential goods and services. So, what are the forward macro projections for an economy increasingly defined by the everything premium? What are the long-term implications for stability, growth, and the very structure of society?
The continued financialization poses several systemic risks to long-term economic stability. Firstly, it can stifle genuine innovation and productivity growth, as capital is diverted from productive investments into asset speculation and rent-seeking activities. Secondly, it creates asset bubbles in critical sectors, making economies more vulnerable to sudden corrections, which can have cascading effects on household balance sheets and financial institutions. We might also observe an increase in zombie companies, firms kept alive by cheap debt and financial restructuring rather than intrinsic profitability, distorting market competition and resource allocation. Our models suggest an increasing fragility in the system, where seemingly minor shocks can trigger outsized reactions due to interwoven financial dependencies.
Regulators and central banks are acutely aware of these dynamics, but navigating them is immensely complex. On one hand, there's pressure to curb asset price inflation and address social inequities arising from financialization. On the other, Any sudden tightening of monetary policy or aggressive regulatory intervention risks destabilizing markets and triggering a severe recession. We anticipate a continued cautious push towards macroprudential policies aimed at specific asset classes, perhaps higher capital requirements for banks exposed to real estate, or more scrutiny of private equity's reach into public services. However, the entrenched nature of capital flows and the global search for yield make a swift reversal of financialization highly improbable without significant coordinated policy shifts.
For ordinary people, the long-term projection is one of continued struggle, but also potential for significant social and political upheaval. If access to basics like housing, healthcare, and education becomes permanently out of reach for a growing segment of the population, social cohesion will inevitably erode. We could see increasing demands for radical policy changes, such as greater public ownership of essential services, stringent rent controls, or universal basic services. The current trajectory is simply unsustainable for a healthy, functioning society, and people will eventually demand a rebalancing of power between capital and community. Trust in institutions, both financial and governmental, will continue to decline if these fundamental inequities are not addressed.
The everything premium is not merely a niche economic trend, it's a fundamental reordering of our economic landscape. It transforms the essential into the speculative, the accessible into the exclusive, driven by the powerful currents of capital seeking ever higher returns. As we move forward, the challenge for policymakers, institutions, and individuals alike will be to redefine value beyond financial metrics and reclaim the foundational elements of a stable, equitable society. The choices we make now will determine whether we continue down a path of increasing financial precarity or build a more resilient and inclusive economic future. Thank you for joining us.